today's the day after Tariff Liberation Day. Um, Tariff Liberation Day, the outcome was worse than expected because I think markets were bracing for, maybe some sort of simplified, but nothing punitive. And then the rates that were announced and the reciprocal were far greater than many expected. So I think today, is not surprisingly a day where the market is now absorbing the shock. And couple quick thoughts just on what the market's doing. We had an opening gap down 3.5%, and from that gap, I mean, we're a little bit lower, but stocks have basically been at the same level. So in a way, I'm not sure I want to characterize it this way, but it's kind of been an orderly sell-off, even though it's been huge. And I think investors then have to sort of over the next couple of days process a few things, right? Because the first thing that we know is the tariffs don't really start till April 9th, which is a week from now. The 10% starts on the 5th, but really um, these much more elevated rates don't start for a week. And um, the White House has been pretty much silent, right? There was no press, there was no White House briefing today. President Trump made 5 seconds of comments today before he got on a helicopter. And so the only voice we really heard from today is Secretary of Commerce Howard Lutnick, who has basically said, "We're not going to talk to anybody, um, and actions speak louder than words." And so I think it's a clear signal to me that the White House wants all these other countries to be caught up in essentially a panic and chaos until April 9th. And then at that point, and this is just my guess, but at maximum pain is when the White House actually then says, okay, let's make a deal. So the stock market, of course, has to sort of process this over the next week or so. Um, I I'm not in the camp that I think there's a lot of downside from today. And let me just share you a couple of thoughts. And of course, then we could sort of, have a discussion again. But the first is, I think as we're looking through this, these, these new sort of exempted items, and Goldman Sachs put this together, the effective rate of the tariffs is 12.6%. And for all the countries, and on $3.2 trillion of imports. Now, while that number sounds huge, um, it is basically in line with like what many thought was the worst case scenario, which is around 15%. And the second thing I think people should keep in mind is that uh, it's really only 6 or 7 countries that really matter. I mean, there were like 100 countries named, and I know people are probably up in arms because there's all these like random countries that suddenly seem to have like penalty rates for their products. But at the end of the day, more than 70% of U.S. imports just come from six places: the EU, Mexico, China, Canada, Japan, and South Korea, Vietnam. In fact, maybe the best way to put it is like there's Mexico, Canada, then there's the EU, and then there's China, and then there's a block of countries, which is Japan, South Korea, Vietnam. And I would say, looking at at those countries, I think the U.S. is going to do something with Canada, Mexico. I mean, they're exempted from these penalty tariffs anyway, so that it's whatever's going to happen with the USMCA. And with Japan, South Korea, Vietnam, they're essentially allies of the U.S. I don't think that they want to foment a new trade war. But of course, Japan, Korea, and China, we're talking about a tech supply chain, so I think that's going out the window. But I think it's not going to be a problem to sort of come to some agreement there, um, and either and those countries can either choose to negotiate or retaliate or do nothing. And of course, I would expect them not to retaliate, but to either negotiate or do nothing. And of course, I'm sure they're going to negotiate. So really, the two uh, regions that are going to be at the center of this is just the EU and China. I mean, I would say that's the only thing that anyone should really be watching. And the EU, I think, at the moment is beating its chest and saying that they're going to be taking retaliatory actions if the US doesn't negotiate. And that's what I think is going to be dominating headlines until April 9th. Um, and similarly, China, of course, is going to seek to do the same, but China and the US have other things to negotiate as well. So China's hand isn't that weak because one, China, number one, is a huge supplier to the US. Two, China, there are a couple of deals that kind of matter at the moment. One is TikTok and one is the canals, the Panama Canal. And the third is that if the US is going to try to do any onshoring, they're going to need a lot of robots. And, the country that's making like all the robots is China. So I think that China and the US, um, China's not going to just not do anything with a 70% tariff rate that they're sitting on, or effectively, I think the math works out with the exclusions like 47% for China. And as far as the EU goes, that's $600 billion of imports. It's $120 billion of tariffs. I'm just gonna just point something out. All right, so I'm kind of like eliminating all this. So I don't think I don't think we're gonna have like a trade war from Japan, South Korea, Vietnam. I think Canada, Mexico, we're gonna figure it out. And China, of course, actually China does have cards. Um, so the question is, if Europe, the EU has $600 billion of imports, and that's really where this is going to be a high stakes game, and the tariff is either 10% or 20. Um, so it's $60 billion. Does $60 billion justify taking $2 trillion out of the stock market today? I mean, that would be my first cut on why I think even though it feels like there's a lot of bad news in front of us, at the end of the day, I, I actually think the U.S. is going to come out fine. And the second thing I would just point out, I guess, because you might get really, you might be very concerned, but, you know, for every 10 basis points that the 10-year yield drops, okay, and I'm kind of oversimplifying this, but it's basically $36 billion less of debt service for the US. So if in yields, have dropped more than 100 basis points. So, we've already essentially cut out $360 billion out of, the US debt service. Um, so you're already, recapturing because of lower interest rates, what you might even think is a burden to households coming. Because of course, US households benefit from lower interest rates as well. So, uh, I'd probably just say I can't tell you that April 9th is going to be like the day of negotiations, but to me, um, I'd be very surprised if we don't see it by April 9th. A bunch of countries, and remember, there's like over 100, many won't really matter. It's going to ultimately come down to what China and Europe do. But I think even those are going to end up being they're consequential, but I think they're going to end up being deals that are better than what we have right now, which is like the worst case scenario.
Hey, Tom. Thanks for joining us, and just want to personally thank you for all the guidance you've given everyone over the past couple of years. I have a little bit of a two-part question here. The first part is, were you personally surprised by the tariff rates that the Trump administration came out with yesterday? This kind of reciprocal half rates. I think the market really didn't expect that we would go half of what the rates are that the other countries impose on us, and then sort of the numerical method to figure out those rates, I think was really in question yesterday. And then B, piggybacking off of what you just said, Do you think the Trump administration is imposing these kind of ridiculous, absurd tariff rates in order to cause so much pain in the stock market that people get scared, they buy bonds, and that gets bond yields to come down?
Um, okay. Well, yeah, I guess there's three parts to that. First, on the level of tariffs, yeah, I mean, that's negative shock. I mean, when you see when you see these rates, and I don't have I'm sorry, I'm just going to just pull up in front of me, but like the stated rates of like 46% for Vietnam, you know, or 34% for China on top of the 20% already, because of fentanyl. I mean, these are just eye-popping numbers. Like you almost, if it's almost like it's like a dark comedy, right? It's what you'd expect in like a, a satire. They were so absurd, as like you said. I mean, these are absurd tariffs. Um, And then what's adding to the absurdity, of course, is that they're not tariff rates, right? These are just calculations of the actual trade deficit as a percentage of basically what we're importing. So it is a really blunt way to try to calculate a tariff, but it's basically saying, we have a trade deficit, so in order to neutralize it, we have to raise prices by this, which is not really a tariff rate, and it's it's not even really, I think, even a cogent calculation of the nature of a trade deficit. So yeah, so they're so out of whack that, look, if this was based on, I'd actually probably be I think the markets would have a different take if this was based on calculated tariffs and calculations of currency manipulation and government subsidies, and someone can try to attempt to tabulate these things. And I think if that was the case, or if they had like a scoring system of abuse, then I think it would feel like there would be a lot more certainty to these. But because I think these numbers just are arbitrary, and it's even created an impossibility for how like businesses can respond to this, right? Like, how does a business respond? Because is this so huge that I'm out of business, or do I have to onshore, or do I have to raise prices? I mean, they're obviously shocking. And again, that's why I get back to, like, I think April 9th is really going to be the more important date, and that's when we start to see breakthroughs, and we'll see how markets react. But I would expect people would be positively reacting to that. Um, and then in terms of like causing stocks to fall, um, and pushing into bonds. I mean, I think a lot of people definitely can question what is the methodology to what this administration's doing. Like, because I think fairly someone might even say like, well, um, this seems even harder for us to track, and how are we supposed to be managing money. But I don't know if you caught Trump's remarks before he got on the helicopter today, but he was saying, he wants the stock market to roar again. I don't think he actually wants there to be a stock market crash, especially in response to this. I mean, maybe until April 9th, he doesn't care if markets are anxious, but the reason, he doesn't want that to happen is if we have a recession, the average fiscal stimulus to get us out of a recession historically is 2% of GDP. So the White House would have to essentially authorize 600 or 700 billion dollars of spending to reverse a recession, um, which would kind of negate the whole idea of like Doge and fiscal austerity. So I don't think they want. I think they actually want maybe the shock to wear off, and they want maximum negotiating leverage until April 9th, and so maybe they don't care if the stock market is stuck for a couple more days, but I don't think they want the stock market to go down.
On that, it's interesting the April 9th date because April 11th we have earnings season really starting up with JP Morgan earnings, Jamie Dimon speaking then, and then Netflix the week after, and then mega cap tech coming after that. I'm curious, you were talking there like the uncertainty for us, just market participants, but for these companies must be crazy. So, I'm just curious on what you're thinking for this earnings season coming up, whether it's around forward guidance and if companies will be giving them or if their timing of April 9th is even important relevant to earnings season coming up.
Yeah. Well, here, we put together like a table of like the worst hit groups today, and then the stocks. Believe it or not, there's actually like 20 industries that are actually positive today on the day. Okay, but the worst hit are home furnishing retail today down basically 20%. Consumer electronics down 15, like Best Buys. Oil, gas, and drilling down 15. Footwear down like 14. Apparel down 13. So not surprisingly, companies that rely on either manufacturing overseas or even in Vietnam or wherever, other places that got randomly named like Malaysia. Um, and of course some tech, but tech, of course, as you know, besides Apple, kind of are faring actually somewhat better. And even if a stock like Tesla is, I think, doing pretty well today, all things considered. But the stocks that are actually positive on the day, like tire and rubber, managed healthcare stocks are up like 3 or 4%. Water utilities, tobacco stocks are up. Household products, soft drinks, healthcare distributors, some food retailers, telecom services, packaged foods, some of the towers, brewers. Um, you know, I think that, like if you look at the stock market reaction today, you'd think that the whole world just got upended, and like we're spiraling into depression. And actually, I'm sure a lot of economists are maybe even saying that that's going to be the case. But uh, these are not. I don't. I think the economy's going to be fine, and I think that's going to be the message from earnings season. Is that companies that have good businesses and like moats and visibility, they're on the margin. Probably pulling ahead. I mean, I think there's going to be some companies that look like really superpower companies because they're less affected by this. And then, of course, the ones that are down today, they're the ones that have to rethink their strategy because they do have supply chains that are stranded. I mean, I guess at the end of the day, it is a fact that in the next 3.5 years, it's going to be hard to make shoes in Vietnam cheaply if there's a huge tariff on that.
Tom, following up on Tesla, I 1000% agree with you, and I think a lot of people would as well. Which is that given the delivery numbers and given the volatility from tariffs today, you would imagine Tesla would be down like 15-20%. But it's kind of holding on. So do you think that is emblematic of the fact that the worst has been kind of priced in on Tesla and on earnings? Yeah, it might go down even more, but maybe we don't revisit those March 13th lows. And do you think it still could lead a potential V-shaped recovery?
Yeah, I mean, I think, I have to see how the closes today. I think it would have been better to see like, you know, the arms index hit 2, like the trend. Um, but the put call, is elevated. So, some of the right things are happening. And, today will be there'll be some positive divergences. So I actually think the technical picture is getting a little better. But one thing to keep in mind is that, since all this turbulence started, Tesla's outperforming by like 15 percentage points, right? So like let's say you took the March 13th lows and compare it to now, right? So we've like S&P's retested or whatever. Tesla's up like 15%. Um, and Bitcoin's up modestly and MicroStrategy's up like 16%. So the things that were like leading us down at the start of this year aren't actually taking another leg lower, right? They're actually stabilizing here. So I'd probably say that's to me that's kind of a good sign, right? I mean, even like Palantir is actually outperforming the market today. Um, so it's not, it's yeah. I mean that I I'm hopeful it's soon. Like today is definitely a disappointing day. But like I said, the market's kind of just did most of the selling in the morning, and it's been holding this level. I mean, that's not such a bad thing, but um, I'd say the next point of visibility between now and April 9th is really when the next country makes a deal, right? And maybe it's not until April 9th, but from that point on, I think the investors are going to realize that today was the maximum point of negativity. So yes, I expect some V-shaped recovery, but now the timing is a little bit harder to judge just because we really don't have the Band-Aid completely ripped off until April 9th.
Wanted to jump in real quick. And first off, this was very cool, something that your team shared with us in advance of this for our listeners today. There's actually a 30-day free trial to check out your research on Fundstrat Research, and that's just fundstrat.com/Tom, TOM, for those that want to check that out. 30-day free trial, which is pretty cool. And obviously, within your research, one of the big things that's a focus for you right now is your ETF, which launched back in November. This is the Fundstrat Granny Shots US Large Cap ETF, GRNY is the ticker. I just wanted to get your thoughts on, that ETF in this current, market landscape and how you're approaching it.
Um, yeah, so I mean, Granny Shots, let me give a little background, is we based on our research model that we've had in place since 2019. So for people who have been subscribers, we have a core portfolio called Granny Shots. And the way it's constructed is we look at the most important themes, multi-decade themes that exist out there. And today, it's things like AI and cybersecurity, the global labor shortage, the millennial demographic, and the fact that the Fed is easing financial conditions. And we identify stocks that are most positively correlated to the theme. So in other words, we find the strongest stocks within each of those themes. But then you just end up with a huge portfolio. Really, to make it a granny shot, a stock has to appear in more than one theme. And that way you have a stock that has basically several levers of growth. And so that ends up with a concentrated stock list of around 30 names. And Granny Shots since 2019 has outperformed the S&P, um, that research list every year for 6 consecutive years. And it's now an ETF. Now, of course, the ETF is having a tough year this year because the S&P is in a drawdown. But I actually think that that's not surprising to me because it's not designed to be a defensive portfolio. It's really designed to give you exposure to the most important ideas. And so, like names that are in it are things like Palantir and GE Vernova and Costco. But it does have financials like Goldman Sachs and JP Morgan. I mean, these are basically the most important companies that are tied to the most important themes. So, I would think of it as once we're through the tariff turmoil, which is what we're experiencing now, um, these are all the names that investors are going to want to own, but they also have the best earnings growth. And our process does make sure we're not buying, insanely expensive stocks. So that's really the approach to Granny Shots. And by the way, it's named after Rick Barry, named after a way of shooting free throws, which is underhanded, but it was popularized by NBA Hall of Famer Rick Barry.
Yeah,
Yeah,
I saw the graphic on your website talking about like the 93% shot, doing it underhanded. So, Tom, we're coming up on the 30 minutes we have here. We really appreciate you joining in. People should go in, like Gav was saying, the research up in the nest above, given a 30-day free trial. Seems like now might be a great time to go in and check that out. Since we pinned up in the nest above, the link is up there. But Tom, I want to know if you have any final thoughts, anything you want to leave the people with. Seems like
Yeah,
we're kind of in a little bit of uncertainty until April 9th. We'll see, but I want to get your thoughts. Appreciate you.
yeah. I mean, look, I know this is the day that you're going to feel maximum bearish, okay? Um, and then you want to either get out of stocks completely, but just keep the following in mind. One, for this entire decline in the S&P that's been taking place, the bond market hasn't been as ruffled. We look at high yield spreads, and high yield spreads they've widened, but they have not even made 1 year wides, meaning they're barely reacting to all of these tariff headlines. And when stocks and bonds diverge, I would just say this: the bond market's the better economist. The second is, it's pretty rare to have an opening gap down of 3.5% decline. In fact, we've just put this together, and this is the seventh largest negative opening gap in 40 years. And just to give you some stats, because there's always different context, but if you look at the six that preceded it, the sixth worst, okay, and you said, what did stocks do 1 month later? 6 out of 7 times the market was higher. So I think we're flushing out a lot of panic here. Um, Obviously, it's orderly, but we're still flushing out a lot of panic. And the VIX is elevated. Y- it's strange. This sounds strange, but you're better. You make more money when you put money to work at a high VIX, because the VIX is a measure of fear, and so um, the VIX can't stay at 30 for a month. So as the VIX starts to calm down is when investors come back into the water. So it's painful today, but I wouldn't give up hope um, at all, even for a pretty sharp bounce again. But I'd say it's going to probably happen more around April 9th, if I had to guess.